a new requirement which has kind of popped up in 2019 and slowly gaining momentum and interest of the Zatka authorities, and also becoming more and more important for the corporates to understand and fall in line with the requirements. Interestingly, the transfer pricing may have a lot of repercussions in the longer run, where the companies which are not covered now, for example, companies below 100 million Saudi Riyal, may also need to understand and plan their affairs to suit the requirements of the transfer pricing regulations, so that they shape up their contracts and transactions and create their entity structures accordingly, so that they don't damage their business in the longer while after the implementation happens. These transfer pricing regulations are like the natural progression of starting taxation in various geographies of the GCC side of the world, that is UAE implementing corporate tax, Bahrain talking about corporate tax, Saudi already having the Sagia companies under the net, as well as the Zakat companies also under a small amount of tax already there. So all these invite attention of the authorities as to whether all the income which should have been disclosed in a particular entity or into a particular tax jurisdiction is been disclosed or not, whether the fair share of tax is coming to the economy or not, and so on. So there is a lot of to and fro going on in Saudi, as per our understanding, for the companies to understand, implement, and structure it. This is one side of the story. The other important side of the story is how the implementation will happen. What are the practical ways and means through which these implementations can happen? How the companies can restructure and think about doing it, and what are the basis? Like, for example, in Saudi, there are not many companies which are listed, not many companies which are giving full disclosure of their books of account. So there is very limited data for doing any kind of benchmarking activity, any kind of comparison activity, and so on. So both sides. The first side is the technical side of the implementation. That is why the implementation is happening strongly in the GCC world now, because of multiple geographies getting covered under the tax regime. The OECD pushing all the regimes to think about BEPS, that is base erosion and profit shifting. The countries which are not covered under tax regime are kind of pushed to become relevant and important by implementing tax. So a lot of things are happening on Y side, and what side and how side of the transfer pricing, that is how the transfer pricing will get implemented. What are the ways and means to do benchmarking? What is the practical model that will get adopted by all these countries? What will actually satisfy the authorities and how the authorities will look at it are the what side and the how side of the transfer pricing. So today we will, with Chirag, we will try to cover both these why and what side. APMH has been operating in these geographies for a while. UAE, Saudi, Bahrain, of course, we have a full-fledged setup. Oman, Qatar, also we do few activities on regular basis. So APMH understands the challenges. On the other side, APMH has seen the Y side of it and what side of it way beyond what these geographies have still experienced in India, because of income tax laws being very matured here, and a lot of activities happening. Already there are transfer pricing regulations in place. Already there is transfer pricing officer that has been nominated by the income tax, and lot of scrutiny, assessments, and transaction evaluation happening in India, where we are very, very active in this side of the world. So a lot of these experience can be useful to the corporates, the CFOs, the customers, the companies who are adopting to these regulations. And we would want to, put this experience to work for all of you. So from that angle, this, webinar becomes very important. We are also going to record this webinar for repeat use by all the CFOs and all the companies and all the participants who have already joined and would have liked to join but couldn't join for any reason. So definitely you can take a look at APMH YouTube channel for these and other videos which are relevant to your company and your type of requirements. Also, at the end of the session, feel free to ask questions. We have a panel of experts. We have Amlesh, Pranav, myself, Chirag, and of course, more from the audience can also, participate in the Q&A, and we can definitely add value to each other. So we will definitely consider Q&A at the end. Of course, whenever you come across any question, you can put the details in the chat box and ask us those questions. Whenever relevant, we'll read out those questions and we'll kind of try to cover them during the presentation as well. With this, I would like to welcome Chirag for talking on the topic. And we will listen to him for half an hour, 45 minutes for a quick deliberation, and then we'll take it from there. Maybe we'll ask questions and we'll sum up the activity. Amlesh is there. He keeps on traveling to multiple geographies in GCC. So definitely you can be in touch with Amlesh for on his WhatsApp. We'll share the number for your questions. So that is another window through which you can reach out to us. So with this, thank you. Welcome to the webinar. And I will hand over the discussion to Chirag. Chirag is a very senior chartered accountant and has been looking at transfer pricing, international tax, cross-border advisory for more than 7-8 years now. And he has looked at assessments, practical aspects of how the officers and the authorities kind of think in various situations. So he will kind of take us through the presentation and then we will have a question answer session. Over to you, Chirag.
Thank you, Mitesh. Yeah, good morning, everyone. I hope I'm audible to everyone. Okay. First of all, I would like to thank you very much. Thank you, everyone, for joining the webinar. Friends, we have gathered today to discuss a very important topic, which is about transfer pricing laws, its importance, and the recent developments which have happened in the Kingdom of Saudi Arabia. So as Mitesh has rightly said, that this topic is becoming of primary importance in Saudi Arabia since last few years. Transfer pricing is almost 4 years old since it was first launched in Saudi Arabia. It was somewhere around 2019 when the transfer pricing regulations were first enacted in Saudi Arabia. So since then, it has undergone a lot of changes, out of which some of the recent developments which happened in the last year, of which the amendments have got prescribed from the last month only, from April 2023. So now this matter is becoming of more significant importance for us to understand. So without wasting any time further, friends, let's start with the discussion on what is transfer pricing and what are the laws which are regulating it in Saudi Arabia. The contents of today's discussion will be, first, to have an overview of transfer pricing as to what is transfer pricing, because I'm believing that some of you may not have done this yet in your organization. So first we will have a small discussion about what is transfer pricing. Then we will understand what is the applicability of transfer pricing in Kingdom of Saudi Arabia. Then what are the TP compliances, transfer pricing compliances and documentation requirements which are to be done in KSA. And finally, we will throw some light on what are the recent developments which have happened in regards of TP regulations in KSA. Let us first understand what is transfer pricing, because this concept, as we said, is becoming of significant importance now. Transfer pricing refers to the pricing of the transactions which happens between the related parties. We all are aware that many times it happens that there are two related parties or more than two related parties who are involved into transactions with each other. Government never has any objection when the related parties are transacting with each other, but they definitely start to have objections when the related parties try to take the tax advantages, or I must rephrase, they try to take the tax undue advantage in such a way that they are shifting their profits from a higher tax jurisdiction to the lower tax jurisdiction for their own advantage. Like, if we take a very simple example, let's say there are two entities. There is one organization, ABC Incorporated, and there is another organization, XYZ Incorporated. If both of them are into the same country or into the same tax jurisdiction, then this matter will not be of that much significance. But if we say that ABC Incorporated is established into a higher tax jurisdiction, whereas XYZ Incorporated is established in a lower tax jurisdiction, then it is possible that whatever transactions are happening between them, it is possible that ABC Incorporated is trying to shift its profits to XYZ because of taking that tax rate advantage. So these are the transactions which come under the overview, or you can say the purview of the transfer pricing guidelines. Government always says that whenever related parties are transacting with each other, then the transactions must happen at what we call it as arm's length price. Arm's length price, in very simple words, is the price at which two unrelated parties would have transacted. Like, given a set of circumstances, if there is nothing related between the two parties, then what would be the price they would have charged to each other? Government says that the same price should be charged between the transactions which are happening between related parties. So if I am transferring any of the goods to my related party, any of the services to my related party, or maybe I am extending any loan to my related party on which I am charging interest, or if I am providing any intangible asset for usage to the related party for which I am getting remunerated in the terms of royalty, etc., then all these transactions should happen at arm's length price. So if we understand, friends, in arm's length price, there are three of the key parameters. One is understanding who are the related parties. Second is what could be the related party transaction. And third is setting or determining the arm's length price. Let us first understand what is a related person. From the perspective of KSA, if you refer the transfer pricing guidelines which have been issued in KSA, related person is defined as a person who is having control via ownership. It can be through a natural or a juridical person or both, or control via governance, or the control via funding, or control via business. Like, control via ownership refers to having stake in that another person. So if entity A is having 50% or more of the stake in entity B, we can say that they are related persons. It may or may not be a direct ownership. It can even be an indirect ownership. Like, if entity A is not directly holding 50% or more of entity B, but there is one entity X and A is holding some percentage of X, and X is in turn holding some percentage of B in such a manner that the percentage is exceeding 50, even then we can say that all these three entities are related persons. Similarly, control via governance. If we can say, if we find that there is one entity which is having significant amount of governance authority. What do you refer to governance authority? It means that if entity A has the right to appoint 50% or more of the board of directors of the another entity, so we can say that the effective control of that another entity is with this entity A only, because whatever are the decisions with respect to BOD, board of directors appointment and removal, that is significantly with this entity A. So entity A is having control over that entity B via governance. Similarly, many times entities are having control over each other via funding. Like if there is entity A who has given a loan of, let's say, $1 million or 1 million SAR, Saudi Riyal, to entity B. And let's say this funding which they have provided to entity B is forming a significant part of their assets. In such a case, again, we can conclude there is a control via funding. In guidelines, it is mentioned that if 50% or more of the loans are provided from one entity to another, this loan is forming a 50% or more part of the assets held by that another entity, then it is a control via funding. Similarly, there can be control via business, like there is entity A, which is either providing 50% of the materials to entity B, which is forming a part of the purchases of entity B, or that entity B is taking or entity B is selling more of the products to this entity A. So we can say that these entities are related in such a way that significant amount of purchases or sale of each other are done with each other only, are done between them. So there is a control via business between them. So these are four of the parameters via which, through which government concludes that there is a related party, either through ownership or through governance or funding or business. So if we find any of these parameters becoming applicable in our cases, in our entities, even then we can conclude our entities are related parties. Once we have found out that whether it is a related party or not, then the next thing to understand is what is a related party transaction. So I'm taking you back to the same previous slide. I had written the types of transactions. Providing any goods, like as I said, entity A is either goods to entity B or entity B is supplying goods to entity A. There is a transfer of tangible goods between them. So even this will be subject to transfer pricing rules. Similarly, if entity A is the, let's say, parent company and entity B is the subsidiary company, and entity A is providing, let's say, management support services, a very simple example, management support services to entity B. Even then, this management support services for which entity A might be getting remunerated from entity, this will get covered under transfer pricing rules. Similarly, if entity A has extended any loan to entity B for which entity B is paying any interest to A, even this interest payment will be subject to transfer pricing rules. Or if entity A, being a parent company, has developed any intangibles like any patent or copyright for the usage of which they are sharing with entity B, for which they are charging any royalty from them. In such a case, again, this royalty payment will be subject to transfer pricing rules. So once we have understood what is related party, once we have understood what is related party transaction, these can be the types of related party transaction. Next thing is to understand what is arm's length price. As I briefed you first, that arm's length price is nothing but the price which unrelated parties would have charged to each other. There are certain steps in order to which we can determine the arm's length price. We'll come to the determination part later on. First, let us understand why this whole transfer pricing stuff came into picture. So as it was mentioned by Mitesh correctly, that the Organization of Economic Cooperation and Development, popularly referred to as OECD, this OECD has launched a project called as BEPS, Base Erosion and Profit Shifting, which was done by them in 2013. This project, which was launched by OECD, was a kind of initiative which was launched in order to prevent all the tax evasionary practices which are happening between multinational enterprises who are trying to either plan their strategies in such a way that they are trying to exploit the taxation gaps. Because it's a very well-known fact to everyone that the tax rates of all the countries, that is not common. Like, it is not that everywhere in the world we see the same level of taxation. There are some countries who are taxing very huge rates to the corporates. There are some countries who are popularly even referred to as tax havens, wherein either there are no taxes only or the taxes are very bare minimum. So many times it is possible for all these multinational enterprises who are having their headquarters in one of the country which may be coming into a higher tax jurisdiction, they will try to set up their another entities, which they will call it as subsidiary or they will call it as branches, into such jurisdictions wherein either there are no taxes or, as I said, there are very low taxes, which are popularly referred to as tax havens. So what they will try to do is they will try to create entities into such a jurisdiction through which they will try to artificially shift their profits. See, when they are artificially shifting their profits, ideally they are also artificially shifting their taxes. So they will try to artificially shift their profits to such jurisdiction based countries, companies, to which there will be no taxes only ultimately. And since ultimately all these enterprises, they are forming a part of the single group, single company, which is a parent company ultimately, they are trying to erode the tax basis by creating multi-level of companies into multi-level tax jurisdictions. So this was the primary initiative of Organization of Economic Cooperation and Development to prevent such tax practices, or you can say prevent such unjust tax practices through this program, which was BEPS. So this program, which was launched in 2013, was having a action plan of 15 steps. Out of this 15 steps, step number 8 to 10 was dealing into discuss details with transfer pricing. That what should be the prices which should be charged by these multinational enterprises for transactions happening between them. And action plan 13 was referring specifically to TPD, which was nothing but transfer pricing documentation. So if this was the query in your mind that first of all, why are we even discussing this transfer pricing? It is because of this action plan of OECD, which came into 2013. So in the recent years, because of this increased globalization, because of all these companies which are setting up multi-level organizations in all over the countries, that's the reason because of which even the government is becoming very vigilant in the past few years, and they are trying to bring such plans, such initiatives through which profit shifting and base erosion could be prevented. So TP is actually a result of this initiative. Now let's once again come back to our discussion about what is the applicability of transfer pricing in KSA, that how transfer pricing evolved in our kingdom. Dear participants, this transfer pricing guidelines, as I said, it is 4 years old in KSA. It first started in February 2019, wherein the transfer pricing bylaws, the bylaws, what we call it as regulations, which were issued for the first time in somewhere around late January 2019. Once the bylaws got issued, they were published by the General Authority of Zakat and Tax in February 2019. In accordance with these regulations, see, regulations were just specifying what is to be done. Then how the things are to be done, they were discussed in detail in the transfer pricing guidelines, which got issued by the General Authority of Zakat and Tax in March 2019. These guidelines are getting frequently updated, and the current edition which we are referring to is the third edition, which came in somewhere around November 2021. So right now, if you have to refer to which guidelines are applicable to you, you have to refer the edition which became applicable in November 2021. Then what is the recent update? I will just brief you about it right now, but in detail we'll discuss it later. So what is the recent update is, as you all must be aware, when transfer pricing documentation first became applicable, the bylaws first became applicable in February 2019, they were kept only for the taxpayers who are defined in the bylaws. For your information, the taxpayers were people to whom either income tax was applicable as per the KSA laws, or either the mixed entities to whom zakat and income tax both were applicable. However, initially, transfer pricing bylaws were not applicable to the zakat payers who were 100% zakat payers. In July 2022, the board of directors of Zatka, they first extended this proposal. They put this proposal to extend the bylaws to zakat payers, and they invited all the reactions from the people, that what are their reactions and what are their queries and all that stuff. So a detailed discussion happened over all that stuff. And finally, in April 2023, the transfer pricing bylaws got amended. TP guidelines and TP bylaws in KSA got amended to include even the 100% zakat payers in the scope of TP rules. So now this is a very hot topic which has become applicable, that now TP bylaws will become applicable even to 100% zakat payers. So even they will have to comply with these rules now. So we'll discuss that amendment once again in detail once we are done discussion of what is the way or steps in order to determine the arm's length price. So first let us discuss that, because if you recollect my previous discussion, I was referring to three key parameters of transfer pricing. One was understanding the related party, second was understanding the related party transaction, and third was determination of the arm's length price. So let us first throw some light on how to determine the arm's length price. Understand, friends, whenever we are determining the related party transaction and we are determining the arm's length price, we have to follow certain steps. In the first step, we conduct a detailed functional analysis. Functional analysis refers to understanding and evaluating the value chain as to the transaction which is happening between the two related parties. Who is creating the value in that chain? Like, just to take a very small example, if entity A is into manufacturing of electronic products, so since it is into manufacturing of electronic products needs frequent updation and research and development. So it is possible that entity A would have done that extensive R&D and they could have developed certain intangibles. Now, if there is entity B, which is located in some another country, which is a subsidiary of entity A, let's say entity A is just supplying the manufactured product to entity B, who is just doing the marketing of those products. Can we conclude that the value which will be created by both these entities would not be the same? Like entity A, it is into extensive R&D, research and development. So obviously, whatever is the share of profit which these two entities will earn combined on the sale of that final product, out of that share of profit, obviously the share of entity A should be significant, because they have done the entire R&D, they have done the entire manufacturing in the chain. So they are the ones who are creating more value in the chain. Whereas entity B is just doing the marketing and then finally selling it. I'm not saying that marketing is not a valuable activity. It is a valuable activity, but compared to the activities which entity A is performing, the value creation done by entity A was significant. But as we mentioned earlier, if entity A is into a higher tax jurisdiction, whereas entity B is into a lower tax jurisdiction, it is possible that entity A might still shift its profits to entity B. For that only we conduct a detailed functional analysis first, wherein we understand, it is also referred to as FAR, FAR, wherein we first try to understand what is the functions performed by each entity, what are the assets which are utilized by each entity involved in the transaction, and what are the risks which are assumed by each entity. Once we are done with the functional analysis, we have understood who is creating what kind of value. Then the second step is to select the most appropriate method. I'll first take you to the next slide to refer to the 5 universally accepted methods of transfer pricing. These are the 5 methods from which we can try to determine that which pricing would be most suitable in our related party transaction. See, out of these 5, each of them is situation based. Like it is not that we should select the one which is giving us most good results in our favor. No, it is actually dependent on the circumstances which are applicable in our circumstances. Like just to give you an example, comparable uncontrolled price method, also popularly called as CUP method. This method is predominantly used wherein the transaction between the related parties is having a equally comparable transaction between unrelated parties, and there is no significant differences between the functions performed between the two. Like if A is selling a product to B, which is a related party, and there is also a sale of that same product from A to some unrelated party, then the method which we can use is comparable uncontrolled price method, because we will have a direct basis to compare that if A is selling to related party, they are charging 100, but if they are selling to unrelated, they are charging 120 or maybe 90. So we can directly compare. But as we said, most of the times such comparable transactions are not available. Like what if entity is just selling to related party? In that case, the method cup will fail. So in that case, we will have to resort to some other method. Like maybe we can resort to resale price method. But even resale price method fails in situations wherein the related parties are extending some additional things. Like even if there is a related transaction and unrelated transaction available, like A is selling some product to related for 100 and they are selling the same product to unrelated for 120. We won't be able to use cup, but we can use resale price method if we know that the transaction charge to unrelated is 120, because for unrelated, even warranties are extended by this entity A. So they are charging that extra for extending the warranties. So when we know that there are some extra services performed by the main entity to the related party or to the unrelated party, and the price difference has occurred because of that, then we can try to subtract those differences and arrive at the margin which is generally charged to a related and to a unrelated. See, in the same manner, these three methods, cost plus method, transactional net margin method, and profit split method are used. Profit split method is mostly followed in those organizations wherein clear demarcation of all the functions performed is available, which is most of the times not available. But if you're having clear demarcation of all the functions performed available, and you can assign and allot the prices, or you can say the margin to each of these products, then you can opt for profit split method. I won't go into too much details of these methods because anyways it's a procedural part, but I hope you got a gist of how to select these methods. It is not that some or the other method will be directly applicable to us. We will have to go through the circumstances which have occurred in the transactions between the related parties and then decide the method. Popularly, TNMM, transactional net margin method, is mostly applicable because most of the times these functions are not clearly demarcated. So transactional net margin method basically focuses on the net profit which a entity earns. So that is most highly applicable method of TP which is followed. So these are the five methods from which we will have to select the most appropriate. Then the next step is very significant part, which is economic analysis. See, understand, whenever there are related parties who are transacting with each other, understanding the economic circumstances also becomes very significant. Because if there is an entity which is located, let's say in USA, and there is another entity which is located in, let's say, Singapore, in such cases, it is possible that the economic circumstances of both these two countries might be very different, drastically different. Similarly, if some entity is located in KSA and there is some company which is located in a country like India and all, in such cases, again, the economic circumstances may be very much different. So we need to understand that what is the economic circumstances, situations applicable in each of these organizations in these countries, and then do the benchmarking process. Like we will have to take a sample of certain number of companies, because we can't do this transfer pricing determination of ALP just with a handful of companies, like just with 5 to 10 companies. You will have to select a sample of at least thousands of companies, And then you will have to keep filtering them, that which organizations are not listed, you can remove them. Similarly, which organizations are not having adequate data available, you might remove them. Similarly, which organizations are loss making, they are not profitable, you can remove them. So like this in steps, you will keep filtering the companies in such a manner that ultimately you will be left with some 4 to 500 companies. And then you will apply your brainstorming on these 4 to 500 companies, from which again you will do the functional analysis once again, like which of the entities out of this 400 500 are exactly performing the same functions which your entity is performing. And then you will finally do that benchmarking process, wherein benchmarking is nothing but you will try to select the prices which are charged, or maybe the profit margins which are charged by some 10 to 15 companies. Like you will finally filter 10 to 15 companies after this process. And then after this, out of this 10 to 15 companies, you will apply a range. See, it is possible, as I said, not most of the time 100% data is available. So even the government authorities understand this concern. Also, it is possible that the final 10 to 15 companies which you have selected, some of the companies are earning a profit margin of 10%, whereas some are earning only 2 to 5%. So you can't directly compare even with this 10 to 15 companies. So what all these guidelines suggest is, even it is mentioned in the OECD guidelines, that you take a range. ELP should never be taken directly with reference to one company. If there is a sample, ultimate sample remaining of 10 to 15 companies, you take a range out of that. There is a 25th percentile and 75th percentile range which is prescribed in these rules. So we take the percentile 25th and 75th and then median. And then ultimately our ALP should be between that range. So just hypothetically, let's say if that range is coming, 3% is the 25th percentile and the 75th percentile is, let's say, 12%, and the median is, let's say, 6. And our profitability, our ALP is coming, our price is coming, let's say 7. Then we can safely conclude that we have charged ALP, arm's length price, because our price is falling in that range of 3 to 12 with a median of 6. So anything between that range and above the median is considered ALP. Even below the this median will be ALP only, but that can be still disputed, or maybe you can say challenged by the authorities. So it is always advisable keep it at least above the median. So these are the steps in which you ultimately determine the arm's length price. These methods I already briefed you. Now let us understand what are the documentation requirements. In KSA, what are the documentation requirements? There are 4 steps. One is general documentation which is to be maintained. There's a master file which is to be maintained. There's a local file which is to be maintained. And then there is a CBCR report, country by country report. We'll discuss all of them. General documentation. The general documentation refers to the basic information as to, are there any related parties of the organization? Was there any related party transaction done during the year? So it is just like a checklist wherein we start selecting all those parameters that yes, we have a related party. Yes, we had done the related party transaction. Then what was the value of the related party transaction? All these informations are mentioned in the disclosure form. Why we call it as disclosure form? Because in this form, we are disclosing the facts, whatever is the factual data of the company. It is also referred to as CTDF, which means controlled transaction disclosure form. The CTDF has 2 parts, popularly referred to as 2 sections. Section 1, which says just fill the disclosure data. As I said, it is just mentioning the facts. Section 2 refers to CBCR notification form, country by country notification form. See, as I said, many times some of the companies, they are having multi-level subsidiaries and multi-level branches and companies into different countries. So if you have such a organizational structure present in your company, then you will have to maintain this CBCR notification form also. You will have to select yes for that notification form, that yes, we are having country level country transactions. So you'll have to fill that fact also. So it is nothing but again a fact sheet of how many countries you are involved, then what are the different companies, what are their volumes, what are the profits, etc. You will have to mention in that notification form. CTDF is to be submitted along with the chartered accountant certificate. That CA has to certify that whatever transactions has happened it is a controlled transaction which has happened between the two enterprises, that is whether at arm's length or not. So that declaration will go under this. It will go as a supporting to this disclosure form. This chartered accountant certificate is also referred to as affidavit many times. What is the due date to file this disclosure form? The due date is 120 days from the last day of the KSA taxpayer's fiscal year. So hypothetically, just take an example. If the fiscal year ends on 31st March, then 120 days ends on 29th July. So the last date to file this disclosure form will be 29th July. So it has to be done within 120 days. Similarly, master file. See, master file is actually the bird's eye view. Master file refers to the document which contains information about all the global level operations of the organization, as to what are the different entities who are involved, what is the operational structure they are having, organizational structure they are having, then what is the value and the intangibles which are created, then what are the control transactions which are happening, what are the transfer pricing policies which are followed by each of these organizations. Even this master file, which is ultimately the bird's eye view, it is prepared within 120 days from the last day of the KSA taxpayer's fiscal year. However, focus on the words it is prepared. It is not to be submitted like we were submitting this disclosure form. Submission of the disclosure form is mandatory for all. But submission of the master file is not mandatory. It is mandatory only when it is requested by Zatka. And when it is requested by Zatka, then it is to be submitted within 30 days of their request. Similarly, there are some exceptions to the filing of master file. Natural persons, small enterprises having arm's length value of less than equal to Saudi Riyal 6 millions, they are not required to file this master file. Local file, it is another document. As the word refers local, it is the local file of all the company related, taxpayer related information. So if there's a organization situated in KSA, this file will refer to that organization's information, which is situated in KSA. So it's a document containing the support that how you determine that arm's length nature of the control transaction. So basically all those steps which I mentioned, functional analysis, benchmarking, industry analysis, etc., economic analysis, all of them will form a part of the local file. It is to be prepared within 120 days of the last day of the KSA taxpayer's fiscal year. Again, just like master file, this file also has to be prepared, but it has to be submitted within 30 days of Zatka's request. So only if Zatka is requesting this file, then it is to be submitted. See, even though we say that they are to be prepared, but they are to be submitted only when requested, many times people don't prepare them, thinking that we will prepare them whenever Zatka will request. Ideally, we should not follow this approach, because what if Zatka has immediately asked you to submit these files and then you are finding it difficult for a person to make these files for you? So then in order to avoid that unnecessary last moment rush, it is always advisable that whenever you are making that basic documentation, disclosure form and all, it's always advisable to make these master file and local file also. So even if Zatka is not requesting, it is always advisable for our reference to maintain these files. Same exception which was applicable for master file, it is applicable to local file. All the natural persons and small enterprises who are having arm's length value less than equal to Saudi Riyal 6 millions, they are not required to make this file. Similarly, next is country by country reporting, CBCR. This is again very popular documentation, because in country by country reporting, you are actually including the group's information, not just the or taxpayers information, but the group's information. You are including even the financial facts here. In CBCR, you are also maintaining the revenue details of all the group related entities, then headcount as to how many are the employees and officials who are employed in these entities, then what are the taxes which are paid by all these entities on a country to country basis. So the focus here is country to country basis. So I can conclude that this is actually the most important file, because in this file, you will mention the group company name, as well as what is the revenue they are generating in a particular country and what is the taxes they are paying in the particular country. So when you will refer this file, actually the governmental authorities will come to know that whether there is any profit shifting or not, because when they will see the group entity names and they will see their revenues which they have earned in different country to country and the profits they have paid in different country to country, so they will be able to conclude whether there is any profit shifting or not. So I must say that this is the file actually which gives the basis to these governmental authorities to start digging. Okay, so it's a very important file which is to be maintained. Due date is 12 months from the multinational enterprise group's fiscal year end date. So basically the head company, the parent company, whatever is their fiscal year's end date, within 12 months, this file has to be made. So these are the 4 levels of documentation which are to be done. There is general documentation which is to be done. There is a master file which is to be maintained. There's a local file which is to be maintained. And then there is a country by country reporting file which is to be maintained. Now to the most important part, which is the highlight of today's session, that what is the recent development to TP bylaws. The board of director, as I stated earlier, that in July 2022, the board of directors of Zatka, they had put a proposal that now we want to implement TP guidelines, TP bylaws even to zakat payers, 100% zakat payers, because earlier to them it was not applicable. So when they received positive responses from people, then finally in April 2023, they approved the below amendments to the transfer pricing laws, which are becoming effective from the fiscal year starting from 1st January 24. So right now, still we have a timeline of 6 months to get prepared to face this amendment, which will become effective from 1st January 24. So what is the development basically? Two major developments. One is that the TP bylaws are now applicable even to zakat payers, which was earlier not the case. Secondly, they are introducing APA, Advanced Pricing Agreement provisions for tax and zakat payers. We'll discuss what is APA in detail. First, let us understand what is the documentation update, which will come into picture starting from financial year 24. So understand, they have put some phases, like there are 2 phases in which this amendment will become applicable. First phase will run for 3 years from 24 to 26, and the second phase will start from 27 onwards. In the first phase, they are saying that if the value of transactions with the related party, if the value of transactions with the related party is, let's say, Saudi Riyal 48 millions and less, then disclosure form and affidavit is anyways mandatory to that entity. Additional documentation, what do we refer to as additional documentation? Master file and local file. CBCR was anyways mandatory even earlier. CBCR was mandatory even for zakat payers earlier. So the amendment is actually focusing on 2 files, that additional documentation of master file and local file. So if the value of transactions with related party is SAR 48 millions and less, then disclosure form and affidavit refers to that CA certificate. They are mandatory, but master file and local file are not applicable. If the value of transaction between the related party is SAR 48 million and SAR 100 million, between this range, then disclosure form and affidavit, they are mandatory, but additional documentation becomes optional. It is not mandatory, but it is recommendatory. It becomes optional that if you want, you can start maintaining those 2 files, master file and local file. If the value of transactions with related party is SAR 100 million and above, then even the disclosure form and affidavit is mandatory, and even the additional documentation is mandatory. Similarly, phase 2, which will start from 2027 onwards, if you can observe, the value of transaction 48 million SAR and less, disclosure form and affidavit is still mandatory. Additional documentation is not applicable. However, for SAR 48 million and above, even the disclosure form and affidavit will become mandatory, and even the additional documentation will become mandatory. Investment funds, they are not covered. Basically, the mutual funds kind of entities, they are not covered in the first phase, but they will get covered from phase 2 onwards. So if I have to summarize, if you are a small entity and you are not having many complex transactions, what you have to maintain is only affidavit and CTDF, the disclosure form. But if you become a medium entity, the word small medium refers to the value of transaction criteria. So if you're a medium entity and you have certain level of complex transactions, then not just CTDF, even affidavit, local file, master file, these become mandatory for you. If you're large and highly complex organization, then practically everything becomes applicable to you. CTDF, affidavit, local file, master file, and CVCR. So I hope you can observe that the requirements just keep on increasing the way your volume of and level of transactions keep on increasing. So we can safely say that government is going to put some more compliance burden in the coming years on all the entities, whether it's a small, whether it's a medium, whether it's a large organization, everyone will be burdened with the compliance requirements. Let's discuss APA. What is that advanced pricing agreement? See, earlier, what approach was followed by government was you follow a TP guideline, you select whatever price you want, and then we will conduct your audit and assessment. So what used to happen is if the person, taxpayer, has not taken proper care in determining that ALP, it used to get challenged by the government. It used to get challenged by Zatka in all these assessments. So later on, there used to be disputes over all that ALP and all that stuff. So even the time used to be lost, money used to be lost, etc. So ultimately, finally, they have come up with this advanced pricing agreement program, which will begin from 1st January 24. In this program, what will happen is taxpayers, they can sit with the government authorities and they can mutually agree on a transfer pricing guideline and a rule and a method which they will want to follow in their company. So once it will be a pre-decided methodology which they will follow, which will be agreed by the government also, the chances of future litigation will reduce. Because it is like right now what they are doing is not known to government. So that's why there are litigations. But if what they are doing will be already known to government, the chances of litigation will reduce. Point is, when can we apply for APA, Advanced Pricing Agreement? Only when the transaction which is included under the APA is more than SAR 100 million. Because if it is less than SAR 100 million, you can't apply for APA. By when we have to apply for APA, the request should go within 12 months from the beginning of the first financial year under APA. So the moment it begins from 1st January 24, if you want to apply for APA, apply it before 31st December 24. The APA which will be sanctioned by the government will be applicable for the next 3 years, after which again they will look into your data and they will reconsider the APA. What are the benefits of going under advanced pricing agreement with the government? As I said, if you go under this APA, all the terms, conditions will be already discussed with the management, with the government authorities. So that will also help you in doing your financial reporting in a more robust way, as well as there will be less possibility of disputes in future. Because as I said, what you are doing is already known to them. So even you will be more transparent in your financial reporting, as well as there will be less chances of disputes which will be raised by the government. It will prevent your cost as well as time consuming audits. See, right now what happens is, since there is no APA, people are doing whatever they want. Most of the times, as I said, they are not even maintaining the documentation. So whenever audits are initiated by General Authority of Tax and this Customs and Taxation, whenever Zakat and Tax, whenever GAZT is issuing any audit, most of the times it becomes very time consuming because people had not maintained proper documentation. So there is a to and fro which is happening. Government is asking for some documentation, you are not having that. So you are going and you are first preparing that documentation. The time extends, money is lost, too much of pressure happens in those audits. So this will be saved if you're already having an APA. Similarly, as I said, if you are not doing proper compliance, then maybe General Authority of Zakat and Tax may levy some penalties on you, which will be after the assessment's completion. So you will be saved out of these penalties if you already have a APA with you. Similarly, as I said, there will be APA validity for 3 years. So you'll have a certainty for 3 years in your mind. For the next 3 years, you can just focus on your business rather than focusing on the documentation. Similarly, there will be judgment around provisioning. Whatever provisions, entries you are passing in your books of accounts, you're doing it out of some judgment. You're not just doing whatever you want. So these are some of the benefits of going under APA. Consequences of non-compliance. See, what are the consequences for not complying with whatever I have discussed till now? As I said, difficulties which will be faced in assessments and audits. See, when you are not doing any compliance, obviously you are going to face some difficulties whenever assessments are opened, whenever audits are initiated by General Authority of Zakat and Tax, because whenever they will call you for audit, the first difficulty you will face is there's no documentation. So what to submit to them? So you'll rush for making those documentation. And it is not possible to get a professional to prepare the documentation for you at the last hour. So you'll try to reach to the big consulting firms who are very costly, who will charge you very exorbitant rates. So this will be the first difficulty which you will face in assessments and audits. Similarly, as I said, penalties may be levied. Right now, there are no prescribed penalties, but as I said, transfer pricing is just evolving. It is growing in KSA. So over the next few years, we can definitely expect the penalties also to get prescribed. And believe me, it will be very huge amount. Similarly, there's a risk of discredit to the business. See, if you are a compliant organization, your stakeholders, all the people you are dealing with, they always are happy in dealing with you. But if you're a non-compliant organization, it is possible that government might publish it facts that it is a non-compliant organization in some or the other government portal, which will bring a discredit to your business. I'm not saying it will definitely happen, but what if it may? You can't take that risk with your business. Similarly, there's another mutual agreement procedure just similar to APA. See, APA is something you can do in advance. But what if APA is not there? What is happening right now? If there is a dispute, even in case of a dispute right now, there's a solution possible to you guys, which is go under a mutual agreement procedure. So if there is a dispute between the taxpayer and the government authorities, they can enter into a mutual agreement procedure wherein they will go through a negotiated settlement and they will try to resolve the dispute by arriving at a common figure. Like if government is saying 100, you are saying 120, let's negotiate, sit and negotiate and bring it to 110, which will be a win-win for both of them. So such kind of arrangements which you can enter into is referred to as MAP, Mutual Agreement Procedure. It's nothing but a mechanism for the resolution of the international tax disputes. But the benefit of MAP can be taken only for issues pertaining to tax treaties, which refers to all these double taxation avoidance agreement treaties. It does not extend to the local taxes. What are the time limits to request for MAP? It is within 3 years. The moment you receive a notice, you have to initiate that action within 3 years for this MAP. So basically, what's the summary of our entire presentation today? There is a time to take TP health check. What do you refer to TP health check? See, just like when you start feeling that you are suffering from some ailment, what is the first thing you do? You first go and do a health check. You do a preventive health checkup. In that case, it is nothing but you are taking a diagnosis as to understand what is wrong with me right now. And once I have understood what is wrong with me right now, only then I can take the measures to correct it. Same thing is offered by us right now, that first, it is very important for you guys to do the TP health check, as in go through the facts of your business, take an in-depth review of your business, that what is right now happening in your business. Are you a TP compliant organization or not? And before you do that, first understand whether TP is applicable to your organization or not, whether your organization has developed a policy for TP or not, whether you are maintaining all the required TP documentation and all or not. So TP health check is nothing but understanding the gaps. Right now, are there any gaps in our organization or not? Or if yes, then what is our readiness to fill those gaps? And what if tomorrow we also come under the TP guidelines from 1st January 2024, then what is our preparation to meet all that stuff? So that is what will be covered under TP health check, to understand the areas where we need a support, where we need an assistance. So our strong suggestion will be, first do a TP health check. And for that only, like, this actually completes my part of discussion. I would once again like to invite Mitesh sir to take further from here, who will help you understand that who is the right person who can assist you in this TP health check. Mitesh sir, over to you.
Yeah, thanks, Chirag. So I hope this was a very lucid presentation, and there was a lot of clarity that everyone got from this presentation. Um, this is like this started with a small form where everyone started worrying when the Zatka portal started asking for certain information from everyone regarding who your associate enterprises are, what are you doing with them, what is your pricing policy, how are you dealing with them, and so on. So everyone started asking each other, including the auditors, the consultants, everyone, that what is this and why these questions are being asked. Slowly, people got more clarity about transfer pricing coming into play. Although 2019, the basic structure was put in place by the Saudi, there were a lot of difficulties and issues that people were discussing about. And that's why the team put together this information, because with our vast experience in countries like India, UAE, etc., we thought that we will also try to enlighten the audience in Saudi Arabia regarding the same. APMH Accounting and Consultancy WLL is located in right next door to Saudi, that is in Bahrain. We have a big setup in Mumbai with 100 plus team members working together to service the corporates with various requirements, including zakat, withholding tax, VAT, e-invoicing, which is slowly growing and becoming big in Saudi Arabia, and now the transfer pricing requirements. We, focus on these niche areas where the corporates have a lot of stress, and kind of help them with the expertise and also ideas for implementation of the expertise. So we kind of call ourselves as, someone who is helping you implement the expertise. So it is action over consultation. We do timely and system driven jobs. So it is very structured way in which we operate. We have a very good battery of experts who take care of the requirements. They understand in depth regarding the laws, and they are very good at explaining the corporates and the directors, CEOs, and all the stakeholders regarding what is changing, how it is changing, and how it is impacting your business. We focus also on systems and processes, that is IT. Nowadays, most of the stuff which humans were learning before, now IT is learning. So when you look at VAT also, when implementations happened in Saudi Arabia, UAE, Bahrain, Oman, we found that people told, you please explain this to the system, you please systematize it for us, and it will be easy for us to follow. Then we also focus a lot of energy on being available to the right audience at right time. So the team is always available to guide you, help you, handshake with you, and sort all your problems on regular basis. And of course, cost effective, because we being Indian chartered accountants, we always believe that the organization should get at least 3 times ROI of what they pay us, right? So we always focus on your ROI more than the fees that we want to charge. So it is a very, very ROI driven exercise. We understand that how we can reduce your cost, your penalty, make you more tax efficient and more tax structured. And especially in jurisdictions like Saudi Arabia, where people formed entities right, left, and center, focus on investments, and managerial structures and ownerships now are suddenly thinking of restructuring many of those entities because of the pressure on the tax side. So a lot of experience is required to think over it and structure it in such a manner so that to make it more tax efficient and still more documented, more structured, and less risk averse for penalties and prosecutions. So this with this you can reach out to us on +9665970943339, sorry, 4335, or you can reach out to us on amlesh@apmet.in or mitesh@apmet.in or chirag@apmet.in. A lot of time and energy has been put by a large team to think through various aspects, like what tools will be required in Saudi Arabia, how TP Catalyst will work, how Orbis or Oriana database will work. The team has also spent a lot of time in thinking through the transfer pricing models and methodologies which are possible to implement in various countries like Singapore and India and USA, Cayman Islands, which is a tax haven. And through this experience, we thought that it will be relevant experience for Saudi Arabia as well. So we have kind of put together a nice team, nice IT thought process, or you can say the database thinking. And of course, the third is extensive analysis and survey of your jurisdiction as to how what will fit you, and of course the industry understanding and knowledge. So with this, all this, I invite you to reach out and talk to us on a one-on-one conversation if you feel it convenient, and we can then take you through your scenario and case study, and then we all can decide if we want to work together on some project or the other. Okay, so please reach out to 966 59 709 4335. Thank you everyone for giving us a patient hearing. Thank you, Chirag, Amlesh, Pranav, all our team members and all the clients and friends who participated in this webinar. We have APMH YouTube channel, so you can subscribe it for more such programs and activities. And we will put this video as well on the YouTube channel very soon. Thank you. Thank you very much, everyone. Thank you.
Thank you very much, everyone.
We will close this webinar.
Yes, Mohammed Azim, I hope your query has got addressed. If you have any other query, you can mention.
No, it's still not answered.
Okay,
This
so you were asking about that value, whether that value will be cumulative for all the transaction till date, right?
yes, exactly.
No, right now, whatever we have understood from the guidelines, detailed guidelines are yet to be issued, but whatever we have understood from the amendment, it will refer to a year's transaction. It will not refer to the cumulative of whatever has happened in past. And even all these APA provisions, they will not change anything which has already happened in past. They will have a
Alright.
retrospective effect only. Prospective effect, sorry, not retrospective.
Okay.
Okay.
Okay. Thank you. Thanks so much.
Okay.